Hi, Charles Sizemore here. So the last couple of weeks, inflation has been sort of an underlying theme. You see it everywhere. You see it at the grocery store. You see it in home prices. Well, today we're going to be a little bit more systematic about it. I actually have prepared a list of things that are, yes, it's on a legal pad. I'm pretty low tech. It's not on a teleprompter. Just deal with it. But at any rate, I did prepare a list of things that are currently showing shortages or are expected to be in shortage conditions by early summer. Shortages, of course, mean rising prices. This is the reality we're dealing with today. There are some good investment implications for that. We can actually make money on this. But before we get into that, let's go through the list. At the top, computer chips, and this actually flows down to a lot of what comes next, partly because of increased demand, but mostly because of some coronavirus shutdowns and an inability to kind of ramp production back up quickly. There is a global shortage of computer chips. I know this for a fact because my son wants a new gaming PC, and I had to politely tell him no. Because prices are actually just too high right now. I'm not willing to pay $4,000 for a video card for his gaming PC. That's where we're at. That's the price if you can get it. Getting the chip at all at any price, like even from some guy in a trench coat in a dark alley. I mean, it's just good luck. I mean, they're not there to have. That's flowed through to autos. Where it's funny, I bought a car a year ago during the worst part of the pandemic, and it was fantastic. I mean, I almost felt guilty. They were practically giving the car away, and I'm not a very good negotiator when it comes to buying new cars. I think I've gotten ripped off on every car I've ever bought. The car salesman just sees me coming, but I really got a good deal last year. Well, that is over and done with. At this point, it's a seller's market, so to speak. You're not getting any sort of incentives. I mean, you're taking the price that they give you. Not just for new cars, also for used cars. It's gotten so crazy in used car land. Used cars are actually appreciating. Now, that cars never appreciate in value. It's a one-way street. They go from more valuable to less valuable. But used cars are actually appreciating in value to the point that I have this old, 11-year-old piece of junk that I keep around for doing work projects. If I want to go to Home Depot and buy whatever wood or something, I don't want to put that in my nice car. So I keep the old crappy car. I'm considering cleaning up the old crappy car and selling it because prices are that irrational, right? Well, I can't say they're irrational, but prices are just that stretched right now in used cars. And by extension, rental cars. I'm taking a little weekend trip into this week, and I was shocked. I had legitimate sticker shock by how expensive rental cars are. Why? Because last year during the pandemic, the rental car companies slashed their fleets. They sold off a lot of their inventory. And now they're in a mess because they can't buy back. They can't buy new cars to replace the ones they got rid of. And so there is a shortage. Prices are rising there as well. Moving down the list, gasoline. This seems amazing because about a year ago, a little over a year ago, the price of gasoline was negative. They would actually pay you to take it away. There were jokes in Texas that people were going to drain their swimming pools and dump gasoline in it just as an investment scam. Clearly, that did not happen, but this is how quickly things change. In the year that has passed, we've now moved from a massive surplus to shortage. And part of it is due to drivers. Like, we don't have enough drivers to move the fuel. I'll get to that in a second. Homes are also wildly inflated right now. Now, you can get into a spirited debate as to whether rising home prices constitute inflation or is that just rising asset values. But considering that the house is, I consider it inflation, particularly when you see some of the action in the market right now. And you could argue that it's demand pull inflation rather than cost push inflation, but there's a little bit of both. But in my neighborhood, I'm actually considering selling my house. Prices are through the roof right now. They've gone up $100,000 per house just in a couple months. I mean, this is not normal. This is this is a market that does raise some serious red flags. Is it sustainable? Related to homes is, of course, lumber. The price of lumber has actually come down a little, but at one point it was up over 500% from its yearly lows. Well, obviously, if the price of lumber is now inflated, then the price of everything that you use lumber for, such as new homes, for example, also becomes inflated. Now, what happened here? It's also a similar story. Production got cut back during the pandemic, and all of the trees that weren't, cut down and converted to lumber a year ago, they're now not on the shelves at Home Depot or, the lumber store. So this is due to the pandemic in large part, but we have not been able. It's funny, our economy, the trend of the last 30 years has been for just-in-time inventory. Let's keep lean inventories. We don't need to pay for storage. When you have a bunch of inventory lying around, things get spoiled. It's better to buy what you need when you need it. Well, we're seeing now the limitations of that. When you do have a major disruption, you still have problems a year later. So there's that. Moving on, toilet paper. Toilet paper is now in shortage again. That's one of those things that when I'm an old man in a rocking chair thinking back on this time, I don't know that I'll ever understand the toilet paper shortage during the pandemic. Why? I understand hoarding canned goods, man, but toilet paper, I'll never get it, but that was the reality. Well, it's still the reality. There is now another toilet paper shortage, and it's actually spilled over to baby diapers. Now, this is a problem for me because I do have a baby in the house. So it may be a very messy summer if this isn't resolved. Moving on, furniture. So I am making a lot of changes these days. I was looking at selling my house. I still may. As part of all that, we're looking at new houses. That's going to be painful. Furniture. Good luck getting a couch these days. There is actually a shortage of furniture because, again, global supply chains, things get disrupted. It's a domino effect. It flows through the whole system. And next thing you know, it takes you 6 weeks to get a couch. So that also causes prices to rise. I mean, it's very, very simple math here. When you have a shortage, when you have too many people chasing too few things, that does lead to cost rises, inflation. Moving on, chicken. Well, it's funny. I probably travel too much, but the joke, well, chicken becomes too expensive, just switch to steak. Whatever. Chicken is getting rather expensive these days. You are going to start seeing that at the supermarket and in restaurants. That does flow through. This one is really near and dear to me, bacon. Looks like there is going to be a shortage of bacon this summer. That is one of the few items on this list I'm actually willing to pay a premium for because, come on, it's bacon. You gotta have bacon. Life's not worth living without bacon. Moving on, chlorine. It's going to be a very unsatisfying summer if you can't take a dip in the pool because there's no chlorine. But you look at this. This isn't necessarily pandemic related, but there was a fire, there was a disaster in a Louisiana plant that makes chlorine, and that's flowing through the whole economy right now. Again, this kind of comes back to the just-in-time inventory deal. If people actually had supplies on hand and didn't rely on things coming at the last minute, this really wouldn't be an issue, but that's where we are. Even the price of chlorine is going to be rising. Corn. Now, corn, I tend to look at soft commodity prices. I don't draw a lot of hard conclusions there because, look, prices of soft commodities rise, they fall. It can depend on the growing season. I don't really consider that a trend, but apparently the cost of corn is also trending higher. And then finally, and this is a big one, this one actually matters for everything else, labor. So there is actually a labor shortage right now, despite the fact that we have relatively high unemployment by the standards of the last several years. We're still sort of technically in a recession. We have not recovered from, I think the economy, the latest stats show that the economy has recovered about 90% of its pre-COVID levels, but we're still 10% under. Yet despite all that, we actually have a labor shortage. I've gone to restaurants that had to alter their hours because they can't find enough people. this is not anecdotal. This is all over town, and it's really all over the country at this point. Now you can point to a couple of different things here. Is it the stepped up unemployment benefits where people were getting paid more to sit at home than to work? Yeah, clearly that's a big part of it. But when does that get resolved? When does that finally flow through? When do these workers finally decide to get back to work? I don't know. And in the meantime, until they do, prices for labor are going to just keep going higher, which again flows through. So the Fed is really insistent that all of this inflation is transitory. It's temporary. It's going to pass. Maybe it will. I think some of it certainly will be. Do I really think the price of lumber is going to stay at 500% higher? No. Do I think that chlorine is going to? No. I mean, clearly some of these things are going to fall back to normal levels, but the big ones may not. We have a housing shortage in this country because after the 2008 meltdown, home builders were very reluctant to build out a lot of speculative inventory. They tended to be more conservative. They did a lot of cash buyers. They did a lot of higher end homes because those home buyers were willing to put more down and were more stable. And so the result is you actually have a shortage of housing in the country now. And that was before COVID. I mean, that was problematic before COVID. Then COVID happens and everybody wants to flee the cities, and all of a sudden the suburban lifestyle looks great. Whereas pre-COVID, you might have loved the urban lifestyle, but being stuck in an apartment for a year, suddenly a white picket fence looks pretty good. So this doesn't get fixed in a day. You can't just build millions of houses tomorrow. It takes time. You have to build them. This inflation in home prices may persist for a while, particularly if the Fed keeps pushing interest rates or keeps suppressing interest rates. But really the biggest one is labor. Now that people have gotten used to getting checks for doing nothing, essentially, I mean, if we call it what it is, they've gotten used to getting a lot of assistance. They've gotten used to kind of these extra checks. Getting them to go back for their previous wages is going to be difficult. And I do realize, yes, you take away the benefits, you just make them go to work, fine. But at the end of the day, a lot of people just opt to sit on the couch and not go to work, or they'll move in with their girlfriend or boyfriend or whatever, and just whatever, they'll cut expenses and they won't work. I don't know how you get around that. I mean, to me, this surge in wage labor is that's really the most concerning for inflation trends, because that's the hardest to tamp down. A lot of things will resolve themselves. A lot of these shortages that are problematic, they will just resolve themselves. Eventually, the factories will get back. They'll produce those microchips. They'll produce those cars. They'll produce chlorine, whatever. They'll produce all toilet paper. They'll produce all these things, and prices will regulate. But the labor thing is much stickier. It's much slower to move. So we may just have inflation. We may have inflation like we haven't had in several decades. I would say it's far too early to talk about hyperinflation. It's far too early to talk about, those doomsday, Weimar Republic stuff. I mean, it's too early for that. But I don't think it's too early to talk about 1960s or 1970s style inflation. And if that causes the Fed to kind of get more restrictive, you could actually have stagflation. You could still have these inflationary trends that are hard to stamp out on top of a weak economy. So that's problematic. That's the environment we're in. That's not good, but there are some opportunities here. So in recent weeks, I've talked about gold, I've talked about gold miners, I've talked about industrial metals and the companies that mine those. I've talked about a lot of natural inflation hedges. Today, I want to talk about timber. And I'm going to butcher the pronunciation of this company because it's a German word, and it is what it is. My pronunciation leaves a little to be desired, but Weyerhaeuser, the timber REIT, ticker symbol WY. This is a company that it's a REIT, it's a real estate investment trust, but they don't really own a lot of buildings, apartments, or anything like that. They own timberland. They own actually a lot. They own 11 million acres of timberland scattered around North America. And their business model is very simple. They plant trees, they let them grow, they harvest them, and they use those trees to create wood products, to create 2x4s, whatever, to create lumber used in construction. And so they do have the fabrication as part of their business as well. They actually create the wood products. But by and large, this is a very kind of low maintenance business. They own and manage timberland, which there's a perception that timberland, trees just grow by themselves. And of course, in nature, they do. But timberland is an active business. You do have to actively plant potentially millions of trees. There's work involved. But once that work is done, the trees are planted, maintaining the forest is pretty easy. You clear out the trees that are ready to harvest, you manage it. It's a pretty simple business. It's a business that requires patience, but it's a simple one. It's also one that's very inflation resistant. So if you do have sustained inflation, the price of all materials, of course, goes up. But timberland is somewhat special in that, trees are protected. You can't just cut down any trees, not like you can cut down your neighbor's tree and use it for firewood. There are rules here. And so the timber REITs actually, I can't say they have a monopoly, but they have, they do control the supply here. That's very good for them. I think this is a very good business to be in. If you do have a recession coming down the pipeline, I don't necessarily think that's imminent, but if we do have one, and let me back up for a second. The overall bullish theme here is that, look, we're probably looking at some kind of inflation ahead. So raw materials prices tend to do well. Apart from that, we're also looking at a building boom. We have just a drastic need for housing in this country that requires a lot of wood. We also have, still being proposed, nothing's been done yet, we do have the largest infrastructure spending bill in decades on the table, which will also create more demand for these raw materials. All of that is fantastic. All of that speaks to this kind of short to medium term impetus for timber prices to stay high and timber companies to do well. Now, the other side of that is, okay, what if I'm wrong? What if something comes down the pipe that just grinds all this to a halt? What if we have a recession? What if interest rates go to the moon? Whatever. Well, that's the beauty of timber. You don't harvest it for a while then. If demand slacks, you just leave the trees in the ground, you let them continue growing, and then, well, lo and behold, you let them grow a few more years, they're bigger and more valuable. So it's not like a mine where if you have whatever, copper, iron ore, coal, whatever in the mine, it doesn't grow. Like that's been there for probably millions of years. It's not going anywhere. The amount of copper doesn't change. The amount of coal doesn't change. But with timberland, if you're not actively harvesting it, you're just letting it grow, it actually does become more valuable. So that is a nice aspect there. So, whenever we recommend a stock, we always like to kind of run it through Adam's green zone filter. And I am proud to say that Weyerhaeuser rates well. It rates an 81 overall, which makes it a strong bullish stock. A strong bullish stock in our rating is anything, of course, over 80. And we, based on our historical work, we believe that strong bullish stocks should outperform the market by about 3 times over the next 12 months, at least on average. So let's break it down a little to kind of see where the stock kind of picks up points. It's funny, you think of this being sort of a stodgy conservative business, but it rates highest on growth. It rates a 93 on growth. That's interesting. I was actually a little surprised by how well it rated there, given that the building industry has not been particularly healthy over the last 10 years. But that does speak to their good position within the industry and very good management there. Despite rating very high on growth, it also rates very high on value, rates an 82 on value. That matters. Value stocks have really been doing well this year. The last 10 years plus has very, very much been a growth market. We've had more of a value market in 2021. Now this is both a growth company and a value company, so that's good. I feel like we're very well covered here. It also rates very well in quality at a 79. That's interesting because REITs generally don't rate that well based on our quality score because of their quirky accounting. Now, this is a little bit different in that this company doesn't have a lot of depreciation charges because it owns timberland, it doesn't own buildings. But all the same, it is interesting that despite being a REIT, it rates really high based on our quality scale. I like that. I consider that a major plus. Now, momentum, it actually scores fairly well as well. It scores a 70. Momentum has been sort of tricky in recent years. Momentum has essentially, momentum stocks have essentially been tech and social media. There's been very few exceptions on that. But and so the highest momentum stocks are still tend to be in that sphere. But 70 on momentum is no joke. That's a very solid score. I like to see, for a gritty old stock like Weyerhaeuser here to rate 70 on momentum at a time when it's mostly flashy tech stocks. That's noteworthy. Volatility, it rates a 61. That's certainly respectable. That means it's less volatile than 61% of the stocks in our universe. That's good. I'll take that. Over time, we prefer less volatile stocks because, well, they outperform. Over time, they outperform, and they do so with less heartburn. It's actually the secret to Warren Buffett's success. He buys a lot of low volatility stocks and then effectively levers them up with his insurance float and then just waits. The only metric that this stock rates poorly on is size. It rates an 8 on size. But there's what do you do? I mean, it's a larger company that that's no indictment of the company's quality. It's a large company. It is what it is. So overall, this company does rate well. I feel very comfortable being in something like this, even if my basic theory or my basic premise that inflation is here, and I can't even say inflation is coming. Inflation's already here, and it's probably going to stick around for a while. Even if that really doesn't end up holding true, let's just say I'm flat out wrong for reasons that I have not identified. Let's just say the Fed's right. All this is transitory, and inflation doesn't really happen. I still feel like this is a good stock to be in based on its high ratings here on our system. Our rating system is objective. It doesn't have theories that it wants to prove. It doesn't have an ego. It's raw numbers, and those raw numbers suggest this is a good company poised to do well in the years ahead. Now, of course, we always have to mention the dividend. This stock does not yield. It does not have a monster yield by any stretch. It yields about 1.8%. But it is worth noting that is significantly higher than the 10-year treasury right now. That's actually a respectable yield in this day and age. Now, the yield was previously higher. They ended up slashing it during the pandemic. They cut it in half. I do think it's highly likely that they build that dividend back up to its pre-pandemic levels. I think they'll do that sooner rather than later. But if they do, then you're looking at a yield based on today's price, closer to that 4% range. But, for the time being, this is a 1.8% yielder, and that's okay. In this market, that's actually not bad. So, there you have it. We have inflation. It's here. I can't say it's coming. It's already here. I actually hope the Fed's right. I hope it is transitory. I just don't know if I believe that. And so if you do think that inflation in some form is going to stick around, then these raw materials plays are really, you want to have at least part of your portfolio there. And Weyerhaeuser is definitely part of that story. So that's going to wrap it up for this week. We'll catch you next week.